unknown market any day. Abhiram Eleswarapu is with us, Head of India Equity at BNP Paribas. Abhiram, good to have you with us here. Thank you for your time. Your earnings estimates since the earnings season has begun, Abhiram, how have they moved? Have you lowered FY25 earnings expectations? By how much? And where are most of the earnings downgrades?
I think we've seen marginal changes to estimates, mostly cuts, I would say. And that's because we've had some large companies report. Certainly in the consumer area, we've had to downgrade numbers a little bit. Maybe not so much in IT. I think it's still early days with banks. Haven't seen a huge change. But if we just take a step back, I think of the top 100 companies, maybe only about 1/5 have reported so far. Earnings trends are generally in line with or slightly weaker than what they have been in the past few previous quarters. And to be fair, the largest and best companies have reported so far. So chances are that we may see a few more downgrades as we go ahead in the season.
All right. Hi, Abhiram. Good afternoon and good to see you, Win. But you're still saying that India's structural drivers are pretty much intact. If that's the case, some of these misses could be making the markets jittery, which in turn provides an entry opportunity. So what's that theme, that sector that you're still bullish on?
I think we need to look at that statement within perspective. The market's already returned, let's say, 14-15% year to date. Maybe the small and mid caps have returned more than 20%. That's probably more than what we would have expected at the start of the year. So far, things have gone quite well. Now, the structural comment is in light of what investors or the media has been talking about on the China effect and funds flowing into China away from India and so on. So I just wanted to kind of reiterate that from a 2 to 3 year perspective, we still see a lot of structural drivers in India. So that doesn't change. Now, the sectors that we prefer from here on within that, first, of course, we think that where there's really some value, it's still in large cap private sector banks. Again, we've got to be a little selective there, not all banks, but where we like some are those. Then IT services, where we've held a positive view for some time now. And maybe selectively in areas such as maybe hospitals, logistics, EMS. Those are the areas where we're looking at.
And this pain that we are seeing in consumer stocks, where some earnings downgrades have been, do you expect it to be transient? Do you expect things to pick up in Q3, Q4, or will the pain be a little more long-lasting, at least maybe till the end of FY25?
I mean, we think that the pain will last till the end of FY25. I think after the results and then the budget, there was a lot of expectations that consumer staples companies will turn around, will start to improve. That said, if you take history of, let's say, 5 or 10 years, growth rate has actually lagged GDP growth, nominal GDP growth at least. So the sector seems to have gone into this bit of a growth rut. And more so now, a little bit of margin pressure is also building, certainly on the raw material side. Obviously, valuations aren't exactly cheap. And the growth expectations that analysts seem to be building seem to be far ahead of what companies are actually reporting. So I would sense that, staples is probably not the place to be if you have a 2 to 3 quarter view.
Abhiram, hi, good afternoon. So not venturing into staples, looking at IT and I think private banks, you said. What else, given the uncertainties around us, valuations, etc., how else are you rejigging the portfolio, if at all?
Well, I think there are 2 important catalysts to look out for over the next, let's say, 2 or 3 weeks. First and foremost, of course, we continue to have earnings. And as I'm mentioning, maybe we'll see a few more cuts rather than upgrades at this stage. And that's probably a time to kind of reevaluate. More so from a global perspective, what you'll see in the next 2 to 3 weeks is the US election results. And, if assuming there are no major surprises, then they may not have a big impact on the market. But if there's a wave either way, red or blue, that could have an impact. The next bit is on China. I think the next catalyst is really in December. So maybe you can assume that subject may be a little dormant for the next 1.5, 2 months. Then it just boils down to what India is doing and what the results are. By the end of the quarter, I think that people will go back to structural stories. What we're seeing today, I mean, you see the start of or till now this year, what investors were taking sectoral bets. They were taking the views, let's say, industrials will do well or metals and so on and so forth. They took very clear-cut sectoral views. Certainly, power was one of them. Now what we are seeing is intra-sector shifts. So a lot of rotation within sectors and companies that are performing versus those that are not. And that's usually typical of a market where valuations are somewhat full. So any results that are not going as per expectations, maybe you'll start to see investors shift out pretty immediately. into the best performing stock within that space. I think that's what's likely to be the theme for the next 2 to 3 months.
Having said that, I take that point completely, that it's going to be very granular because no two companies could be showing the exact same trend. It's a very different market. But having said that, I mean, what would your top exposures be for every new rupee that you're getting? I mean, how are you cutting it up in terms of allocation?
Yeah. In a rate cut environment, usually, and going back into the, let's say, take a view of the next 6 months or so, financials will be our top preference, especially the really large banks. As the liquidity environment improves, and we're starting to see that already in the last 2 to 3 months or so, that's when usually banks do well. You're already starting to see deposit growth kind of pick up. Maybe we think that over the next few months, it'll start to match credit growth as well. So I think private sector financials would be our top ideas. Second would be large cap and maybe some mid cap IT as well. And that's usually a reflection of rate cuts in the US, which usually tend to spur capex and hence IT spending. These two will be the clear-cut preferences. I think that'll be followed by some structural story. The one that we really like at the moment is EMS companies in India. We're seeing growth rates of 30, 40, 50%. I think that is a long-term kind of view that we've taken. And in general, if you're allocating incremental capital, it's more likely to go into what we've always called affluent India versus more mass market. I think that theme over a 3 to 4 year period is still the place to be.
Okay, Abhiram, final question before we let you go. You know, just around 45 minutes or so ago, we had Ultratech Cement's numbers that came out. And over the weekend, we had Dalmia Bharat. Now, both these two stocks, the miss in comparison to the EBITDA number was anything between 6 to around 8%. However, both the stocks are only down close to 1% to 1.5%. What's your view on cement? For the time being, it seems the street is lending that long handle. Maybe second half of the year will be much better. Would you buy into that thesis? And we have a couple of these other names, like Orient Cement, as we speak, is at the high point of the day. Your view, how do you approach the space?
Well, to be honest, I haven't done a whole lot of work on cement off late, but we're taking a general view that as a house, we've taken a view that capex is not going to be as bad as people think going into the second half of the year. Order inflows in general are not looking very great, at least from a quarter perspective, but we think that execution is starting to pick up. So overall, from a capex perspective, real estate and all of those exposures, we think that things are not as bad as feared. And that's probably what the market is agreeing with. And that's the reason why when companies are missing numbers, the stocks are not falling as much.
Abhiram, you said the next two catalysts to watch. One is the US election and the other one is on China. But you're saying we'll have greater clarity on China only in December. What happens in December?
I mean, whether there's a question of more stimulus or not, okay. I think if you see what's happened with China, obviously the market's gone up a lot, 30, 35%. And once the measures started looking like somewhat underwhelming, then more than half the gains have gone away. And therefore, the next thing really to watch out for is there more stimulus coming? And I think the big meeting is, the next possible meeting for that is in December.
Okay. And Abhiram, just to go back to that earlier point on capex, because capex has suddenly become a untouchable area, right? A complete no-go area. You mentioned EMS as one space, which you're still positive on. What else? And right now, I'm not asking for a 2 or 3 quarter view. I mean, portfolio call, say, at least for the next 1 year to 2 years. What will you stick to in terms of capex? And the problem is where to allocate fresh money, right? Given how high the valuations had gone.
Yeah, I agree. Frankly, valuations make it extremely difficult to pick stocks in India. That's a feedback we're getting from clients across the board. But if you look beyond EMS, then I think the next one is really interesting, maybe logistics. Still a structural story. And you take that exposure without the inherent risk of the underlying commodity and so on and so forth. So therefore, logistics overall is a space that we've liked. It generally looks a 3 to 5 year story. So that's probably worth looking at.
Right, there's some news at the bottom of the screen. This is, I think, very, very important. The Ministry of External Affairs says that they've closed an agreement with China on the